A very good morning to all of you students. Today we will be continuing with the topic of derivatives. So the first topic of today's discussion is on put call parity theory. I hope all of you would have revised the concepts that we have covered in the previous sessions, right? So let's start with the put call parity theory. Now students, in this theory, we will be deriving some conclusions. We will be understanding that how a value of a call option is linked to the value of the put option on the similar underlying, and how market forces makes those prices equal. Okay, so before we go into that conclusion, let us first use the case number 1 and case number 3 which we covered in the previous session. So total 4 cases we covered, right? In which case 2 and case 4 we used for Black-Scholes model that we already covered. And in put call parity theory, we will be covering case number 1 and case number 3. So what was the case number 1? It was purchasing a call option and investing the present value of strike price today, because in case we have to exercise the option later on, the amount equivalent to strike price has to be paid. And case number 3 was purchasing a put option, which is a right to sell, and at the same time purchasing a share in the spot market, because if tomorrow the exercise has to happen of the put option, so I have to sell the underlying. For that I have to purchase the asset or purchase the equity in the spot price. Okay, so let's make use of them, case number 1 and case number 3. So I'm just putting down certain facts which will be true for both the options. Let's say time period is 1 year. We are talking about a call option and simultaneously a put option. Call option is right to purchase. Put option is right to sell. Strike price assuming to be 180. Okay, for both the options, strike price let's assume to be 180. Spot price in the market is, let's say, 150. Sorry. The value of call option is, let's say, 15, and the value of put option, let's say, 10. Please note students, this is premium. The value of a call or a put option is premium, right? This is the pricing of the option. And rate of return is, let's say, 20% per annum. Okay, so this is some information that we would like to make use of while we will discuss about the put call parity theory. Okay, students, please do let me know in case you have any doubt in the previous topics or in the today's session. Okay, please do ask whenever in you're having a query. So first let's talk about the initial cash flows. Okay, by initial cash flows I mean once we are entering into the call option and put option. So let's take scenario 1, wherein we are saying that the person is purchasing a put option. Okay. For purchasing a put option, the person has to pay how much as premium? So this is one. Second is, I'm just putting A here and B here. The second step will be, in case I have purchased a put option, I have purchased a right to sell. For this right to sell, what action should I take in the spot market? Come on, students, tell me. Please answer what I'm asking. If I've purchased a put option, what corresponding action I should do in the spot market?
Purchase a share.
Sorry?
Purchase a share.
Yes, we need to purchase a share, because purchasing a share means we will hold that share. In case right to sell is executed, we will be selling that share under the put option. And just to tell you another perspective, in case you are purchasing a share, then you will gain in case the prices goes up. In case you have purchased a put option, you will not gain in case the prices goes up. Clear? In case the prices goes down, and if you have purchased a put option, you will gain. And in case of spot market, if shares are purchased and the prices goes down, you will lose. So basically your loss is offset by the gain on the purchase of put option in case the prices goes down, right? So this is another perspective to look at it. So spot price purchase a share today. Now, for purchasing a put option, the person has to pay 10 rupees. That's the premium, right? And purchasing a share today, the person has to pay 150 rupees, correct? Which is the spot price. So, in a nutshell, the person will end up paying 160 rupees. This is a initial cash outflow, right? While this person is making the portfolio by purchasing a put option and purchasing a share on the spot market, the person has incurred in totality 160 rupees as the cash outflow. If we talk about scenario 2, in scenario 2, what we have done, we have purchased a call option. So let me tell you, this is actually case number 3 as per what we discussed, and this is actually case number 1. Okay, now purchased one call option. If call option is purchased, then what should I do? I should invest present value or strike price, because tomorrow if the option is exercised, I have to pay strike price equivalent of money to purchase the share. So 15 is the premium on call option. And here I have to invest present value of strike price, which will be calculated how? 180 is the strike price. After 1 year, the strike price is going to materialize. So the present value as on today will be 1 plus R, which is 20%. So it becomes 150. In totality, 150 for investing the strike price, present value of strike price today, and 15 for purchasing a call option. It becomes 165. Okay, this also becomes the initial cash outflow. Now these two different portfolios have been made as on today, right? The first portfolio is made by investing 160 rupees. The second portfolio is made by investing 165 rupees. I hope all of you are clear till now. So let's say this is investor 1, put option holder, we can say. This is investor 2, call option holder. Okay. Now let's talk about their subsequent cash flows. Now, students, for subsequent cash flows, we might have to assume different scenarios, right? Because this is going to happen after 1 year, so it prices can be higher, lower, or some other thing. So let's first take the case of price being as 200. Price comes as 200. This is on expiry. And let's talk about first for the investor 1. Now, if I may ask, this is the option, this is the strike price, this is the market price. Option is which one? Put option, right? Investor 1 is having a put option. Strike price was how much? 180. Market price is 200. So only seeing at this put option, students, tell me whether it is out of the money, in the money, at the money. What is it exactly?
Out of the money.
Very good. This is out of the money. The reason is because the market price is already higher. If I have to sell the asset, I can sell in the open market at 200. Why will I exercise the right to sell at 180? It will fetch me a lower amount. So it becomes out of the money. Clear? So if we talk about the subsequent cash flows now, so on put option, sorry, this is out of the money. On this, the subsequent cash flow will become nil. So whatever premium I have paid already, it becomes a sunk cost for me, right? It has nothing to do with whatever I will gain in future. Then second is shares will be sold at the rate 200, right? Whatever shares I'm holding, I will be selling it at the rate of 200. So my sale proceeds becomes plus 200, right? Whatever holding I had, I will sell it at 200. In a nutshell, I will be making 200 rupees here. Net cash inflow after 1 year is equal to 200 rupees. Then for investor 2 students, sorry, we have an option. We have a call option. What is the strike price? What is the market price? And then let's do the comparison. So option is the call option. Strike price 180. Market price 200. Now tell me whether it is out of the money or where it is in the money.
In the money.
The money, sir.
Very good. And what will be the payoffs for this? What will be the payoff because of this in the money? Tell me. So ultimately, what will be the payoff? Only because of the call option I am asking.
So I will buy the share at 180.
Correct. But here I will get 20 rupees, right? Because the call option will be settled on a net basis. So I'm just saying that we have invested the present value of strike price to mitigate the cash flow impact later on, right? But it's not essentially that we will be purchasing the share under this call option. Okay, the payoff will still be 20 rupees. Okay, now the second part is I will get the investment value back on maturity date. This will become call option. This is in the money. It becomes 20 rupees positive and proceeds on maturity, or let's say investment proceeds on maturity. I will get 180 in totality, and this is how I'm getting 180. 150 is what I have invested at the rate of 20% for 1 year. So I will get 180. In totality, I will get 200 as the net cash flow after 1 year. Can anyone tell me what is the observation for investor 1 and investor 2? What is that you observe at the subsequent cash flows for investor 1 and investor 2? Is there something common?
Cash outflow, sir. I mean, same cash inflow, sir.
Yes, the cash inflow is similar after 1 year. So for investor 1 also it is 200, for investor 2 also it is 200. For both of them it is 200 and 200. Okay, price being 200. Now let's take another case. So this is the A case that we have taken. Let's take B case now. If the price comes down to 100, so this is for investor 1. Okay, this is for investor 1. The strike price, let's put it like this, put option. What is the strike price? What is the market price? Market price is 100, strike price is 180. Now, comparing this, whether it is in the money or out of the money, students, tell me.
In the money.
Yes, this becomes in the money. And what will be the payoff? In this case, what will be the payoff for put option? It will be 80 rupees, right? Because 180 being strike price, 100 being the spot price, 80 rupees becomes the payoffs on expiry. So put option is equal to 80 rupees positive cash flow that we will get because it is in the money. Okay, and the shares that this investor has purchased will be sold at 100 rupees because the market price is 100. So shares to be sold at the rate 100. So this is 180 net cash inflow after 1 year. Clear? Now, just with regard to investor 1, there is one important thing that we can derive. Because of this portfolio that this investor 1 has created, what is happening is even if the prices are becoming lower, still the investor is able to realize at least 180, which is the strike price of the put option. Correct? Investor 2, we are talking about call option. We are talking about strike price and the market price. The strike price is again 180. The market price is 100. Now, since this being a call out of the money and there will be no payoffs against this call option, okay? So, call option out of the money will be 0. Realize on maturity 150 into 1.2 is actually 180 rupees in totality. Net cash inflow after 1 year. This is also 180. For investor 1 was also 180.
So I do not understand what is this 150 into 1.2, sir.
Yeah.
How do we
So
realize that 180?
yeah, I'll just tell you from the first cash flow. So what did this investor 2 has done initially? One is purchasing the call option and second is investing 150 rupees sorry, for 1 year at the rate of 20%, right? So hence this 150 rupees, once it gets matured, so 150 into 1.2 will get 180 rupees on maturity. Sorry, clear?
Okay, sir.
Yeah. Now, finally, what we are concluding from both the above cases is that whatever prices occur in the market, the subsequent realization, or let's say the subsequent cash flow of investor 1 is equal to the realization of investor 2. Is equal to realization of investor 2. And for two different portfolios, if subsequent cash flows are always going to be the same, so the initial value should also be same. Otherwise, what will happen? I'll tell you. See, let me put it like this. This is investor 1. This is investor 2. So in our example, initial value was how much? For investor 1, it was 160 or 165. Yeah, 160 and 165. Yeah. It was minus 160 minus 165, right? Subsequent value, if we take the first case or second case, first case has given us 200, second case has given us 180. So if subsequent realization is always similar, don't you think in the investors will start preferring investor one's position, because for a lower amount you are getting higher, or let's say the equal return? Why will you invest 165 rather than you will increase your, let's say, demand for this kind of a portfolio what investor one is booking? So it will increase the demand of investor one's portfolio. In other words, it will increase the demand of put option, and the price of put option from 10 rupees will increase, right? And somewhere the 165 demand will go down, the call option demand will also go down, so the pricing will also come down from 15 rupees of the call option, and somewhere it will match. So 10 rupees will slightly go up, 15 rupees will come down. Are you able to understand, students?
Yes, sir.
Yeah. So the moment this is the situation, it will happen in such a way that the value of put option will increase and the value of call option will decrease. Why? Because this is a less lucrative investment portfolio. By investing 165, you are still getting the same outflow. You are getting the same inflow what you will get by investing 160. So rather you will prefer investing 160, right? So this increase and decrease will adjust. So these market forces will adjust the prices of call option and put option in such a way that this and this becomes equal. The portfolio values will become equal because their subsequent realization is also equal. So the initial cash flows will also be equal. So this gives us what? Value of put option plus spot price is equal to value of call option plus present value of strike price. This is investor 1 initial cash flow, and this is investor two's initial cash flow, and this is what the put call parity theory is. So investor 1 initially purchased a put option and paid a put option premium, and simultaneously invested into a share at the spot price rate. Investor 2 purchased a call option and invested the present value of strike price for 1 year, right? If you remember in our example. So this is the put call parity theory. This says that this equation will always hold true in a market which is appearing. Okay, clear? Now, practically where this will be used, put call parity theory, practically where it will be used. So it will be used in those places, students, where Let's say you have been given this, and this, and you have to find out the value of call option. You can do that, right? By putting three things in the equation and you can calculate the call option. Or you want to calculate the value of put option, that also you can do. Clear? Any doubts till now, students? Please do let me know till here. Okay, if not, then let's continue with question number 23. So question number 23, students, is a very good question because it covers Black-Scholes model and put call parity theory both. Okay. So it says that the shares of TIC Limited are currently priced at rupees 415 and call option exercisable in 3 months time has an exercise rate of 400. So the spot price is 415 and the exercise price is at 400. Risk-free interest rate is 5% per annum and standard deviation volatility of share price is 22%. Based on the assumption that TIC Limited is not going to declare any dividend over the next 3 months, is the option worth buying for rupees 25? Clear? So first of all, they're asking us to validate whether 25 rupees is the right valuation of the option or not. Calculate value of aforesaid call option based on Black-Scholes valuation model if the current price is considered as 380. Now they're saying instead of 415, you assume the current price is 380. If it comes lower, what would be the worth of put option if the current price is considered as 380? Now they're saying if the current price is 380, then what will be the worth of put option? And lastly, if TIC Limited share price at present is taken at 408 and a dividend of rupees 10 is expected to be paid in 2 months' time, then calculate the value of call option. So this question is very much calculation extensive question because first call option has to be calculated. Then again call option with another spot price, then put option, then finally another call option with another inputs, right? So students, please note in this, there is some additional information with respect to the logs and e raised to the power will be there, which is part of the question. This is actually part of the question. Either it will be given as a part of the question or you will be equipped with something to derive such. For example, the log tables. For example, the yes, Oja, I am just coming into that. We have to use the Z values. Yeah. So this becomes natural log of 1.0375. So this is the additional information which is part of the question. Please note it down. 0.03681. Then again, natural log of 0.95 is equal to minus 0.05129. Okay, these all values will be used. Then natural log of 0.9952 is equal to minus 0.00480. Then e raised to the power 0.05 into 0.25 is equal to 1.012578, and then e raised to the power 0.05 into 2 by 12, 1.0083. So this is, please note this as a part of the question, right? Because these natural logs and e raised to the power will be given or the table will be provided to solve for this. Okay. So first of all, let's apply the Black-Scholes model. What is this? This is value of a call option is equal to S N D1, correct, minus X E minus RT ND2. We had a very elaborative discussion in the previous session on how and what these values are calculated, right? And what is the meaning of these values for us. Okay, clear till now, students? D1, we said natural log of spot price divided by exercise price plus volatility percentage, which is 5 percentage, plus, sorry, this was t plus v square by 2, right? So this 5% is the r, sorry, r percentage, plus volatility square is how much? 22% square divided by 2 whole multiplied by the timing factor, which is 3 by 12, because it is going to exercised in 3 months. 3 by 12, this whole divided by 0.22, which is the volatility rate, under root t, which is 3 by 12. This was the formula, students, for D1. So using natural log of 1.0375 is equal to 0.03681, which is given as a part of the question, right? So this is given here. We will use this, put it in the equation of D1. 03681 plus 0.1865 divided by 0.11, if we solve for the entire things, right? So this will become 0.50327. Okay, so this will become 0.50327. Then D1, if D1 is this much, then we can simply calculate D2, which is D1 minus V under root T, right? So D2 becomes 0.50327 minus 0.11, which is V under root T. This we can simply take the denominator also from here. This is also V under root T, right? So this becomes 0.39327. Clear? Then n d1, which signifies n, and in the bracket we will have 0.50327.
Sir,
Right? So,
uh,
sorry.
in the sum, the D1 calculation it is 0.01855.
So, you are saying here
Yes, sir.
this one?
0.018 55 or 65. Actually, uh, the calculation it is coming different.
Okay. Okay, no worries. Let me just correct it. Just a second. Let me also do for this. So we have 0.05, and then we have 0.22 into 0.22, which is raised to the power 2 divided by 2. Yes, and then whole we will take a summation, and then this we will take into 3 divided by 12. Yes, you are right. So there is a correction here, students. Thanks. I think Oja Jini, right? You have.
Yes, sir.
Yeah, thank you, Oja Jini, for clarifying this. This is actually 0.01865. 0.01865, and then, or rather, it is 0.01855, if I'm not wrong.
Yes, sir.
0.01855, and further, if I just add 0.03681 and divided it by 0.11, divided by 0.11. So 0.50327, this is right number, but in this step I think this was wrong. So this can be changed. Students, please note this one. Okay. Yeah. Then for ND1, now we have to calculate the value of this bracket, right? So the normal distribution table for this bracket needs to be calculated. For that, we will have to refer the standard normal distribution table. Just a second, let us open that. Just a second. Just give me a second. Let me just take it out. The standard normal distribution table. Yes. Let me share the screen back. So we were here, right? Now, for this n 0.50327, if we refer the standard normal distribution table, I've just opened it. Okay. Now, in this, if you see, this is first of all the cumulative table because this represents to the left of the Z score. If you see, right? Because there are, I mean, there are different ways a standard normal distribution table is presented. It can be one tail, two tail, as we discussed, right? But we want a cumulative one, which is here. Then we want it for 0 point. Let's see where are we. Yeah. So if you see this 0.5 here, right? So this 0.5 is having, let's say, if you see on the top now, 0.500 and 0.501, right? So in between our value lies, right? In this between our value lies, so we can take both these values, which is 0.69146 and 0.69497. And let's go back with these two values to our question. So n of 0.50 is equal to 0.69146, and normal distribution for 0.51 is equal to 0.69497. Correct. So in between our value lies. For that we can use the interpolation technique, students. So this will be 0.69146, which is the base value, plus the difference between these two values, which is 0.69497 minus 0.69146. This is the change in the values of the normal distribution table divided by the upper and the lower interval, which is 0.51 minus 0.50 whole multiplied by the desired value minus the lower value interval. So 0.50327 minus 0.50. Sorry. Sorry. So the ND1 comes out to be 0.69281. This is ND1. And if we talk about ND2 now, which is N, yeah, N 0.39327. This was the D2 value, right? For this, we have to take the 0.39 and 0.40 normal distribution values. That we will have to take, right? 0.65173, 0.65 542. Using interpolation technique again. So if you want to see how this 0.39 has come, let's go to the normal distribution table and verify this. 0.3, this one, and let's come to 0.9, this one, right? 0.65173. And similarly, 0.40 is this one, 0.65542. Let me just clean it up so that it is better viewed. Yeah. So 0.39 is this, and 0.40 is this. So we have taken these two values, students. Okay. Now here again we will have to apply the interpolation technique. 0.65173 plus, yeah, that is okay. Ojajini, that is okay. There may be small differences because of the rounding off, right? So should be okay. 0.65173 plus 0.65542 minus 0.65173 divided by 0.40 minus 0.39 multiplied by 0.39327 minus 0.39. Hence, ND2 becomes 0.6529. This is the ND2, students. Finally, now value of the call option is equal to 415, which is the spot price, multiplied by ND1. Now, ND1 was what? Hedge ratio, right? How many shares against one option? So 0.69281 shares against one option. 0.6928 minus present value of strike price 400 divided by e raised to the power 0.05 multiplied by 0.25 into 0.6529. Yeah, then the value of call option will become 287.512 minus 400 divided by 1.012578 multiplied by 0.6529. So the value of call option is 29.60 using the Black-Scholes model. And this we call as theoretical minimum value. So as per the theoretical minimum value, it should be 29.60. Now, what is the question asking to you? Question is asking that what if it is available at 25 rupees in the market? This option is available at 25 rupees in the market. What is our value? 29.60. Now, students, tell me what is your recommendation? Whether you will prefer this to be purchased or not to be purchased.
We will
Given these,
purchase
we will purchase, and the reason for purchase will be
because it is undervalued now in the
very
market.
good, because in the market it is undervalued. So anything which is undervalued is likely to be purchased. Anything which is overvalued, we tend to sell it. Clear? So since the value of call option as per BSM is higher than 25 rupees, hence we recommend to purchase the option at 25 since it is underpriced. Since the value of call option as per Black-Scholes model is higher than rupees 25. Hence, we recommend to purchase the option at rupees 25 since it is underpriced. Clear? Then let's come to B part of the question. So in B part now they are saying that everything remains same except for the spot price being changed from 415 to 380.
Then
Yes?
in A part also current price was supposed to be 380.
No. Why are you saying that? It was supposed to be 380. See, because in the A part, it starts that it is currently priced at 415. And then it is asking you whether it is worth buying for 25 or not. This is the
Uh,
first part.
then
And the,
in my printouts, the calculation of value of call option using 380 is the A point. That's why I was saying.
okay, okay. No, no. So A part is, I think, asking us to do the 415. Then B part is saying that calculate the value of aforesaid call option if the current price is considered as 380. So I'm just trying to read it at again. They are asking us to calculate basis 380.
Okay, sir.
Okay. And then basis that put option, what will be at 380, the price will be. Correct. So spot price is 380. Then, yeah. So spot price is 380. Then D1 is equal to natural log of 380 divided by 400 plus R percentage three by 12 whole divided by 0.22 into 3 by 12. So this is D1. D1 then becomes minus 0.05129. This is given in the question, right? The natural log of basically this 0.95 will give us this value. So this is being used over there, plus 0.01855 divided by 0.11, which is equal to minus 0.297636. Okay, so this is D1, and D2 will be calculated as minus 0.297636 minus 0.11, which is equal to 0 minus 0.407636. So N D1, which is actually equal to N minus 0.297636 is equal to what, and ND2, which is equal to N minus 0.407636 is equal to what? So this is using the normal table. Using table and interpolation technique, I am not actually detailing out the calculation again because it will take a lot of time otherwise, right? If we solve for this, so N D1 becomes 0.3830 and ND2 is actually 0.3418. Now let me just tell you, for calculating this 0.297636, right, we can refer to the standard normal distribution table here. So basically this, the first page is on the negatives one, right? So here we have to take the minus 0.29 and minus 0.30, right? Whatever are the values, we have to use the interpolation technique between them. And the second one is minus 0.407636. So for this, minus 0.40 and minus 0.41 is what we need to use. Clear? So the values have been calculated using such technique. So the value of call option is equal to 380, which is the spot price, multiplied by 0.3830 minus again 400, which is the strike price, divided by e raised to the power 5% into for 3 months, right? So I'm just directly putting the number here, 1.012578 multiplied by 0.3418. So the value of call option becomes 10.52. Clear? Now, an interesting thing over here is if the spot price is 415 and 380 here, so 415 translates to what? It translates to 29.60. I am talking about the premium here of call option. And at 380, it comes down to 10.52. So a reduction in the spot price is leading to the reduction in the premium because it's a call option. It's a call option. Okay. But it's not necessary that whatever reduction has happened here, the same amount of reduction will happen here. It's not necessary. Right? Because here almost 20 and 15, 35 rupees reduction has happened. And here almost some 19.08 rupees have reduced, correct? So it will not go hand to hand, but it will go in the same, let's say, some kind of a proportion or some kind of a same direction. Okay. Now the next part, students, what would be the worth of put option if current price is considered as 380? Now students, tell me, how should I calculate this? There are two options to calculate the put option. Can anyone tell me what are they, these two options to calculate the put option? There are two ways or there are two methods how we can calculate this put option. Can anyone tell me which way or which method we should use to calculate the value of a put option? Yes, students.
Black-Scholes and parity.
Yes, very good. So one is we can use the Black-Scholes model for calculating the value of put option, which we discussed in our previous session. Or the easier way will be, today we discussed about the put call parity theory. In put call parity theory, we need to have four different elements: put option, strike price, spot price, and call option premium. Right? And what I said, in case we have three, we can find out the fourth one. Here, what will be the fourth one? The value of put option. So, using put call parity theory, value of put option plus spot price is equal to value of call option plus present value of strike price. Correct? So value of put option is what we have to find out. What is the spot price? 380. What is the value of call option at this spot price? 10.52. What is the present value of strike price? Strike price is 400. The present value is given by e raised to the power 0.05 into 0.25. So the value of put option becomes 10.52 plus 400 divided by 1.012578 minus 380. Hence the value of put option is 25.58. And the value of call option is 10.52. Now, can anyone tell me why put option value is higher than the value of call option? Another observation, students. So the more you observe, the
Because
more you understand.
because
Sorry?
prices are going down.
Very good.
From
Ve-
145, it's gone to 380.
Right. More importantly, what is happening? The strike price of both put and call option is 415. Sorry, 400. It's 400. If I talk about both of them, the strike price is actually 400 and the spot price as on today has become 380. So don't you think that in such a situation, put option will fetch you more compared to the call option, right? I'm not saying that the call option will totally become out of the money, because still this spot price is as on today. Whether it will become out of the money or in the money will depend on what is the price of spot price appearing on the expiry, right? Clear? So the value of put option is higher because currently the spot price is below strike price. So since spot price is lesser than strike price, hence put option is more lucrative. Are we clear till now, students? Are all of you with me till now? These
Yes,
small
sir.
small things, yeah. So these small things helps to form up our understanding or even to revise the concepts, right? It would have been easier for me to tell that this is the put call parity theory and that's all, because this is already derived by someone, right? But the way, why I want to go in detail and explain to all of you is that in the process of this explanation that took at least half an hour, we actually ended up revising a lot of things that we discussed, right? And also understanding the real logic behind this equation. Okay. And the last part now, students, which is the D part of this question. If TIC Limited share price at present is taken at 408, now they are introducing the third spot price. First 415, then 380, and now 408. And a dividend of rupees 10 is expected to be paid in 2 months' time. Then calculate the value of call option. Now they will be declaring a dividend in 2 months' time. What is the expiry of the option? The expiry of the option is 3 months from now. So that means it will be taken into account for the calculation purposes. Let's come to D part over here. Zero, 2 months, and then 3 months. Okay. So this is the expiry of call option, and this is the dividend payout date. Clear? Now the present value of dividend payout to be reduced from spot price for applying Black-Scholes model. Okay, so the present value of dividend is equal to 10 divided by e raised to the power 0.05 into 2 divided by 12, which is equal to, so here we have taken 2 divided by 12, right? Because it has to be taken at the present value for 2 months, and 5% is the continuously compounded rate. So this value is also given in the question as the extra information that I have supplied earlier as a part of the question, right? So this becomes 10 divided by 1.0083. So the present value of dividend is equal to 9.917 students, and hence the adjusted spot price becomes 408 minus 9.917, because 408 is the current spot price, 9.917, which is the today's value of dividend that is going to be paid after 2 months, is 9.917, and hence the adjusted spot price becomes this much. $398.083. Now, using the Black-Scholes model, we will calculate the value of call option. Here, let's right away calculate the D1, which is the natural log of, now the revised spot price will be 398.083 divided by 400 plus R percentage, which is 5%, plus 22% raised to the power 2 divided by 2 multiplied by the time, which is 3 by 12. This whole divided by 0.22 into 3 by 12 students. So D1 is equal to minus 0.00480 plus 0.01855 divided by 0.11, which is equal to 0.125. So D1 becomes 0.125 students, and hence the D2, which will again be derived from D1, is equal to 0.125 minus 0.11, which is equal to 0.015. ND1, if it comes out to be 0.125, is equal to 0.5498. So here 0.125 again we have used using the table and the interpolation technique. I'm just writing the direct numbers here. 0.15 is equal to 0.5060. I can flash the standard normal distribution table from here as well. So for example, ND1 was 0.125. So for that, 0.1 and 0.12 is this much, which is 0.5776, and 0.13 is this much, 0.55172. So between these two values, the numbers will lie, right? And for ND2, which is 0.015, 0.015, the numbers will lie in between these two, 0.01 and 0.02. That is where 0.15 will lie in between both of them. Yeah, clear? So this using normal distribution table and interpolation technique, we are able to arrive at this value. The value of call option is 398.083 into 0.5498 minus 400 divided by the present value of strike price, right, which is 400, 1.0125, what was it, 78 if I'm not wrong. Yeah, 78. And finally the value of ND2. Okay, I will just share this, Nisha. I will just share the standard normal distribution table again. So we said that for ND1, we will be using this row, the two numbers that I've highlighted, which is 0.54776 and 0.55172. And for ND2, we are using the row that I've highlighted in these two numbers, which is at 0.01 and 0.02, which is 0.50399 and 0.50798. Okay, Nisha, is this okay? Yeah.
Yes, sir.
So
Thank you, sir.
let's, okay, yeah. So let's go back. We have put down the values in the formula, and hence the value of call option is 18.98. Okay, students. So we have covered whatever was asked in the question. Now beyond this, I have 2-3 things more to cover, but let's take a 10 minutes break and then again we will reconvene on the balance part. Okay, so let's again reconvene at 8:41. Yes, thank you. Let's discuss ahead from this question one or two key takeaways. So let's first plot different spot price and against that the different value of the options. If I may say, the different prices at which we calculated numbers are 415, 380 and 398.083. So 415, the value of call option came out to be 29.60. Then 10.52 and lastly 18.98. Correct? This is the spot price and this is the value of call option. Now in this, there is a term called delta, which actually measures the change in the premium because of the change in the spot price. So 29.60 minus 18.98. Let's take 415 and 398 first, right? These two cases first. Divided by the change in the spot price. Right? So we have taken the change in the premium divided by the change in the spot price. So this gives us 0.6277. So for every 1 rupee change in the spot price, the premium changes by 0.6277. This is called as delta. So this term or this concept is called as delta. Clear? So we said that there are three intervals: 380, then 398.083, and finally 415. There are three different spot prices that are available. Right? So from here to here, the delta is 0.6277, which we have calculated above. And from here to here, if you calculate it, which is from 380 to 398, in a similar way, the above we have calculated, the delta comes out to be 0.4687. What I'm trying to say is this spot price reflects at the money approx, right? Because 400 is the strike price. So 398 is the approximately equivalent to the Okay, I think Nisha is saying, can you please repeat network issue? Nisha, what you exactly want me to repeat? The above one, delta? Okay, let me repeat from here. So we started with plotting the different spot prices and the call option pricing, right? So the different spot prices are 415, 380 and 398. These are the three different ones. The respective premiums we have plotted, whatever we calculated. Now, if we calculate the difference between the spot price and in the numerator, we take the difference in the premium, we will arrive at delta, which is this. So 0.6277 is actually denoting for every single rupee change in the spot price, how much your premium is changing. So for 1 rupee change, the premium will change by 0.6277. That's the delta. And here I'm saying if we calculate delta from 398 to 415, that is 0.6277. Similarly, if we calculate the delta from 380 to 398, it is 0.4687. And what I'm trying to tell here is that 398 roughly represents at the money, 380 is out of the money, and 415 is in the money. Right? These are the three different situations. So delta for this one, right, will be 18.98 minus 10.52 divided by. So now we are calculating delta from this and this, okay? Divided by 398.083 minus 380, which will give us 0.4687. Delta will become change in premium, right? Change in the call premium divided by change in spot price. So this symbol is actually called as change. Delta is also change, right? Whatever we, I mean, in a layman term, delta also denotes a change. Okay. So the way delta behaves is for deep in the money, sorry, for deep out of the money. Deep out of the money means deep, very deep. I mean, let's say the spot price becomes 300. That is deep out of the money. Delta is 0. For that kind of a situation, delta is 0. For deeply out of the money. Okay. Then, as and when the option becomes from out of the money to at the money and then finally in the money, the delta keeps on increasing. The way we can see from here as well. So it has increased from 0.4687 to 0.6277. And finally, if it becomes 1 when the option becomes deeply in the money. So if it is deeply in the money, then what will happen? For every 1 rupee increase in the spot price, the premium will also increase by 1 rupee. You're getting my point? For deeply out of the money, what does it means? For any increase in the spot price, premium will not increase because it is deeply out of the money. It is at 300. So if the price from 300 becomes 320, do you think the premium will get calculated? The answer is no, because still it is deeply out of the money. But if, let's say, in case of deeply in the money, the prices reaches to 800, and from 800 now the price is going up to 810. So the premium also will get increased by 10 rupees because it is deeply in the money and the delta for deeply in the money is 1. So this is the characteristic I was trying to explain you through this question. We have taken the facts of this question and hence tried to see the correlation. Okay. So deeply out of the money, delta is 0. Then it keeps on increasing as the option also moves from deeply out of the money to out of the money, then out of the money to at the money, and then finally at the money to in the money. The delta keeps on increasing and it will reach at 1 once the option is deeply in the money, and it will stay at 1. Okay. Clear, students? Yes. So now let's talk about Greeks. So these are actually factors affecting the price of the option premium, or factors affecting the premium of the option. Can anyone tell me one Greek we have covered just now only? What is that? What is that one factor that affects the premium of the option? Just now
Delta.
we discussed delta. Very good. But what is the factor which affects the price of the option in delta?
Spot price.
Very
Spot
good.
price.
It's a very good. It's a spot price. So call option and put option. Let's talk about these two, and let's talk about delta here. So delta becomes the first factor. Okay. Just now we correlated it with the actual numbers. So this is actually change in value of call option divided by change in spot price. Change in value of put option divided by change in spot price. So the extent of change is actually given by delta, students. Clear? And another interesting thing, if the spot price increases, the value of call option will also increase, right? If the spot price decreases, the value of call option will also decrease. Now, in case of put option, students, I want all of you to answer. If the spot price increases, what will happen to the value of the put option, whether it will increase or decrease?
Inverse relation.
Sorry?
Inverse relation.
Yes, inverse relation. So it will decrease. In case the spot price decreases, the price of the put option will increase. Now, students, you will also remember one more place we have talked about delta. So this is something that we are talking about in Greeks. But can any one of you recall, just in the previous session, we also talked about delta. The hedging ratio.
D1 factor calculation.
Yes. Yes, very good. So the hedging ratio is also a delta only. So which is N D1 and minus N minus D1, right? So this was for call option, this was for put option. So from this, we also imply the hedging ratio or delta is positive for call option, and for put option, it is negative. Why negative? Just now we explained, right? There is an inverse relationship between the changes in the prices of a put option and changes in the spot price. So hence it has to be negative. Clear? So this delta is also we refer to as hedge ratio. Okay. Okay, so let's understand through some of the charts also. Let's take call option, buyer, right? The holder of the call option. These were the payoff charts that we discussed earlier. Payoff, and here we said there is a price, right? And the chart was looking like this. So till here the option was out of the money. Ex- exactly here it became at the money. Sorry, here. Yeah, so here it became at the money, and post this it started becoming in the money. One more correction, let me do it over here. The way I need to show is this. Okay, the way this chart will look like is this. Clear? So what I'm trying to explain over here is that delta is zero when option is starting from deeply out of the money and slightly increased from 0 to 1, while the option moves from deep out of the money to deep in the money. Okay, so here what is happening? If I just put it, see what is delta called as for this line. Delta is actually the slope, right? Once the line is horizontal, slope is equal to 0. Then here slope will be in between 0 and 1, right? Then finally, slope here becomes 1 for a vertical line, correct? So what I'm saying is delta is actually the slope of line, slope of payoff line. Clear? Where on x-axis price is there and y-axis payoff is there. Okay. So for call option and for put option, so call option delta moves from 0 to 1 as its stock price increases. Now for put option, delta moves from dash to dash. Let's say this I have filled it for you. Delta moves from 0 to dash as its stock price dash. Come on, students, fill in the blanks.
If 0 to 1, then the stock price decrease should be the fill in the blanks.
Okay, let me note down the options. 0 to 1. If the stock price
Decrease.
decrease. Okay. Any other view? So this is one answer that has come. Is there any other answer, students? Come on, students. You should all participate because the more you
I would
participate, the more you will learn. Don't be afraid of right or wrong, right? Nothing is wrong in this session. Yeah.
so I would say -1.
Okay. Okay. Interesting. 0 to -1. And here you will say decrease or increase.
Decrease. No, increase actually.
Okay. Here you will say increase. Okay. Any other answer? So second option is this. Any other third option? Or all of you are saying between one or two, something is okay. So first of all, for put option, see the idea is whether it is a put option or whether it is a call option, the delta is always out of the money. So the delta is always zero when it is out of the money, right? That is a very simple thing because even if you see the payoff chart of a put option, see this is the payoff chart for a call option, right? If I draw a payoff chart of a put option, the same thing will come over there as well, right? Like this it was, na? Correct? Remember the payoff chart? Payoff, this is price and this is for put option holder. So 0 is okay, but in the previous discussion, we also said that put option delta can never be positive. It will always be negative through this, right? So I tried to explain in two ways. One is through this and one is through this. So it can't be positive one, it can always be negative only. So this is okay, -1. Now this -1 will really mean that the put option is moving from out of the money to in the money. And once it moves from out of the money to in the money, it will happen only when the stock price decreases. Clear? I hope this is clear, students.
Yes.
I think it was a very good attempt from the persons who have answered, from the students who have answered. Thank you for that. Because I was not expecting this actually. Okay, it was a bit difficult, but yeah, this is the concept, right? If the stock price decreases, the put option will become deeply out of the money to deeply in the money, right? The moment it keeps on decreasing, the moment it happens, your delta will also move from 0 to -1, like we have seen in this. Here, the slope will become -1. Okay. So, can I say that for put option, out of the money, in the money, this is -1 and this is 0. And one last thing is actually, just a second. Yeah. So there is one relationship that I wanted to share with you between put delta and call delta. So put delta is equal to call delta -1. Sorry. Okay, so this is a relationship. Okay. Now let's move to the second. So this might be relevant if, let's say, sometime the question might ask you that if you are given this put delta but you want to use call delta in some of the solutions, you can use this relationship. Okay. Now the second Greek is gamma. Okay, so now what is gamma? Gamma measures the rate of change in delta as the underlying spot price changes. Measures the rate of change in delta as the underlying spot price changes. So this is change in delta. Clear? So delta measures the change in the premium. Gamma measures the change in delta. Now tell me, gamma for at the money options will be highest because at this curve the delta is increasing, right? The delta keeps on increasing once the option passes from out of the money to at the money to in the money, right? So at this juncture the gamma is always highest. But for deep in the money or deep out of the money will have, let's say, 0 and -1 or 1 as the delta, right? And that delta will remain almost similar. So the gamma, which is the change in delta, will also be lower, low gamma, right? Because the delta is not changing that fast. So it will become zero. The delta is zero only for the option once it is deep out of the money, right? So the gamma will be low because the delta is not changing. Change in delta divided by change in spot price. Okay. And change in delta we already know, which is the change in the premium of call or change in the premium of put divided by the changes in the spot price. Clear, students? Gamma is clear. Then third is vega, which is sensitivity of options price to the changes in volatility, which is standard deviation. V. We denote it with V. So the way to remember is volatility is starting with V and vega is also starting with V. Right? So the option price is also dependent on volatility, right? And this can be proved using the Black-Scholes model. Black-Scholes model uses volatility as one of the input factor. Clear? So wherein we discuss, right, if d1 is equal to natural log of s by x plus r percentage plus volatility square divided by 2 into t divided by volatility multiplied by under root t. So here if you see, volatility is playing a role in calculating d1, and hence d1 is going into the value of call or value of put, whatever is the case may be. Right. And one more thing which we already discussed, higher volatility will mean higher premium because it will denote a risky situation. It will denote a higher risk. Clear, students? So vega is also clear. Now let's come to rho. This is actually, can anyone guess what will it be? Sensitivity of options price to changes in the, what other things you can see here, students? V we have covered, spot price we have covered. What other things are left in this?
Time filter.
R and T are left, right? So R is actually rho, which is risk-free rate of return, right? Now let me put here a simple thing. Call option, put option. So this is R actually, right? Which is the risk-free rate of return. So if the risk-free rate of return goes up, can anyone tell me what will happen to call option? Whether call option will go up or down? The price of the call option will go up or down?
Up.
Very good. And what about put option? It will go down. So there is an inverse relationship here with the put option. And this can be understood by evaluating the Black-Scholes model formula for both call option and put option. So in call option, we reduce the present value of spot price. But in case of put option, we start with the present value of put option. So sorry, the present value of strike price.
Right
Then we
price.
reduce the then we reduce the spot price. So in case the rate is higher here, correct? So the first term will become lower. This present value will become lower. Higher the rate of return, lower will be the present value. If it is lower, then it will derive the entire value to be lower, right? And in case of call option, if this is higher, rate is higher, so the term that is getting reduced will become lower, and hence the call option value will be higher. Clear? So if you think through, you will get the response over there that why this relationship holds true. The answer lies in the Black-Scholes model for both of them. Okay. Then finally, what is left?
Time.
Yes, time. Very good. So the fifth Greek is theta, which is time. Sensitivity of option price with the passage of time. How is T impacting the prices? Okay. So if I want to just summarize the Greeks, what all are they? One is delta, which is impacted through spot price, and another concept linked here is gamma, which measures the change in delta against the spot price. Second is vega, which is volatility. Then third is rho, which is rate of interest. Then there is theta, which is time. Okay, perfect. So this we are now done with the options. Now let's come to some of the other parts that we have to cover. Let's start with credit derivatives. Okay.
Sir,
Yes.
so can you provide that analysis when time factor increase or decrease, then what will happen to value of call or put?
Okay. You tell me what will happen. It's very easy. If the time factor, it decreases, right? So the call option will also, so the price of the call option will increase, correct?
Please.
And similarly with the put option, correct? Because the time value factor is driving your numbers in the opposite manner. If you see, higher the time value, right? Okay. Any other doubt?
No, sir.
Okay. Now let's come to, sorry, credit derivatives. This is very important, students, from an understanding point of view. Something which is very different from the regular derivatives. Okay, credit derivatives. So students, if you see, there are two kinds of risks. Okay, there are many kinds of risks, but I am restricting our discussion to two different kinds of risks. Okay, I'm just saying there are two different types of risks. One, there is market risk. Second, there is credit risk. Okay, so the market risk, students, is actually all the risk on account of prices, interest rate, stock market going up or down, exchange rate. So these are all things which are actually changing from the market standpoint, right? This is called as market risk, which is mostly dependent on the demand and supply, right? So which market forces drives these values or these risks? These are called as market risk, which are dependent on these. Now then, what is credit risk? Credit risk is non-payment risk.
Debt servicing.
Sorry,
Debt servicing.
sorry, repeat.
Debt servicing.
Debt servicing, yes. So credit risk happens in a situation where you have given a debt to someone and the other party is not able to pay you back on time or interest or principal or not able to pay you at all. That is called as credit risk because you have given some credit to someone and that person is not able to pay. That is called as non-payment risk, or it is also called as counterparty risk, right? So this is arising from non-fulfillment of obligation by the counterparty. Okay. To cover for market risk, we have already discussed forwards, futures, and options, right? In this, we have always talked about how the price movements, we will take what positions in what market, right? These are covered under credit derivatives. So these type of risks, I'm saying, the credit risk, which is the non-payment from a counterparty point of view, is covered over here. Okay. Now, if you see the credit derivatives are basically derivatives used to hedge against the credit risk, are referred to as credit derivative. In our in our topic, we have to discuss two different types of credit derivatives. One, collateralized debt obligations, which we call them as CDOs, collateralized debt obligation. Second is credit default swap, CDS. So collateralized debt obligations, which is CDO, and credit default swap, which is CDS. So we will build our understanding around these two topics. Okay. So first, let's start with collateralized debt obligations, CDO. So from our securitization knowledge, students, okay, I'm just borrowing the securitization knowledge, wherein we discussed that there is an originator, then there is an SPV. Originator has given loans to borrowers. In our example, we took them as mortgage loans, right? Then what will originator do? Originator will assign those loans to SPVs, assign loans to SPV. Then what will SPV do here, students? Come on, tell me. SPV
Issue
will.
securities based on these mortgage-backed loans.
Yeah,
So,
perfect. So then SPVs will go to the investors and they will issue marketable securities. So this process of converting these illiquid assets called as mortgage loans into these marketable securities was called as securitization, right? And here we said that these marketable securities can be of two types. One is MBS, which is mortgage backed securities, and second is ABS, which is asset
Backed securities.
backed securities, right? So the mortgage backed securities were what they have underlying as mortgage loans. What is a mortgage loan? Where mortgage is provided. These are generally home loans where the home is kept as a mortgage, right? So if there is a mortgage loan on that, there is a process of securitization happening and marketable securities are issued. Those are called as mortgage-backed securities. In case, let's say the underlying here instead of the mortgage loans, here instead of the mortgage loans, it's like a credit card loan or car loan or any other thing. So that is called as asset-backed security, right? Because there is a different type of an asset rather than mortgage loan. Why we're calling asset? Because it is a receivable, right? For SPV or for originator, it is an asset. The loan given is an asset. So that is why it is called as the asset backed security. For which, let's say, I am assuming car loan is underlying one. Or let's say credit card receivable is underlying basically. Okay. Clear? So these are called as asset backed securities. Okay. This we have already covered in the part in securitization. Okay. Now let me take you through how it is relevant from collateralized debt obligations. Yeah. So let's take the case of mortgage backed securities. There is an originator, which is a bank. There is a SPV to whom these loans are assigned. And let's say there are these borrowers. Okay, I am assuming let's say 1,000 number of borrowers into 1 crore each. So 1,000 crore is the book value of such mortgage. Okay, and these are sold to SPV. SPV issues mortgage backed securities to investors. Okay, now here, if we have also introduced the role of credit rating agencies, right? So here what we were saying is, if let's say we evaluate this portfolio of 1000 crore, we reach to a conclusion that 80% of them are okay because their credit rating is good. The borrowers will be able to repay, though they don't have a history of default. 10% will default on the interest payment. Okay. Another 10% will default on both principal plus interest. There will be a complete default. Let's say this analysis is already done. Okay. This is the additional information given to us. Now, what SPV will think? SPV will say that, so there are different, so there is a risk, first of all, right? Risk of these 10% not paying interest and these 10% not paying fully. These are the risks that are being carried by SPVs slash originator. Now, what will SPV will do is SPV will frame the MBS market mortgage backed securities in such a manner that it will cover up to the investors. So, for example, it will make tranches. I am assuming three different tranches as below here. The first one is they call, let's say, senior. Second one they call it as mezzanine. Mezzanine is just like a in between layer. Okay, mezzanine means in between. We call it as, right, mezzanine floor we have built, so it's a in between floor. Then lastly equity. Okay, now if you see, senior will get a fixed return and equity ones will get a variable return. So you assume it's something like senior is a debenture holder, mezzanine is a preference shareholder, and equity is a equity shareholder for a company. Whatever rights are attached to debenture, preference, and equity in case of a company, the same rights are attached here. The senior will get a fixed percentage. Debenture holders will keep on getting the coupon rate, which is 8%, 9% fixed. They don't have a risk. So there is a low risk here. There is a medium risk here. There is a high risk here. Clear? So equity will see very high risk, right? Because any changes in the return, or if let's say any borrower is not able to pay directly, equity will face the burden, right? So let's say here the return is fixed as 4%. Here the return is fixed as 10%. Here the return is fixed as, sorry, 4%, 6%, and 10%. But this 10% with a caveat of default. In case anyone defaults, then equity will bear this. So this is called, the creation of these tranches is called as the collateralized debt obligations. So the entire process of securitization by converting the illiquid assets to the marketable securities, that is point number one, and creating different tranches basis the risk return profile and basis the expectation of the investors is called as collateralized debt obligations. And this can happen for both MBS and ABS, right? Okay. If let's say we don't create tranches, if no tranches are created, okay, then in that case only one option is there, right? There are no different options, only one option is there. But in that one type of option, credit risk will be there, right? We will not be able to eliminate the credit risk. Through above process, at least we are able to eliminate the credit risk, right? From the SPV point of view and from the originator point of view. Okay, clear? Then let's come to type of CDOs. One is cash CDOs, right? In this case, originator sells the underlying to SPV and realize cash. Okay, it's an actual transfer of the CDO. Oh, sorry, it's an actual transfer of the underlying. Second is synthetic CDOs. In this case, the actual transfer never happens. Only the credit risk gets transferred. So originator will transfer to SPV only the credit risk, which is equivalent to that 20%. The actual sale of the assets or the underlying will not happen. Okay. Now what happens in case of cash CDO? The collateral assets, for example, the mortgage loans will move away from balance sheet, right? From balance sheet. So it will go off from the balance sheet of the company, from the originator, right? But here they will still be part of the balance sheet. However, only the economic effect is transferred. Economic effect of credit is transferred to the SPV. Clear? Any questions, students? Let's come to the second type of credit derivative, which is credit default swap. Credit default swap. It's a combination of three things, students. Credit means loans given, right? Default means non-payment of such loans. And swap means exchange. So here what you do, you exchange or you swap your credit default risk with someone. Now, what are the parties involved? There is a protection buyer and there is a protection seller. So this protection buyer, what he will do is he will pay premium to protection seller, and protection seller will commit to protection buyer that in case of any default, I will make good the default. Sorry. On reference obligation. So these are some of the technical terms that we are using. So protection buyer and protection seller are two terms which are understood, right? Protection seller is someone who will make good the default. Protection buyer is someone who is already having a risk of credit default and he will end up paying premium to protection seller. Now let's say, what is the reference obligation? Reference obligation is the obligation against which the credit default is secured. Let's say the original loan. In our above example, it was mortgage loan. So that mortgage loan becomes the reference obligation, right? So this is someone who has done the initial borrowing. The premium will be paid as a percentage to the loan amount. Generally, it is paid as a percentage to the loan amount. So this reference obligation, it can be bonds, it can be corporate bonds, corporate debt, it can be anything, right? Anything which is given as a loan, etc. Now, this protection buyer is already exposed to the credit risk. Risk, why? Because the protection buyer has already given the loan, and hence the protection buyer is exposed to the risk. And this protection seller is the one who is getting premium. Let's say now premium will be paid 0.5% of the loan amount. This is how the premium will be calculated. It is very much similar to an insurance company. This protection seller is very much similar to an insurance company, wherein the premium is received and the risk undertaken is the credit default under this transaction. Okay. Now, in this also, there are two types of settlement. One is physical and second one is cash. So in this physical settlement on default, I'm saying the protection seller will actually deliver bonds or so basically they will do the 100% bonds delivery, etc. This is the physical delivery. For cash, only the differential payout will happen. Okay. So this is it from the understanding of credit default swap and the collateralized debt obligation, students. Okay. Rest you can go through from the study material. You will be able to understand through these terminologies. In case something is not clear, please do let me know.
In cash settlement, you said that differential payout will be there. Such a differential payout will be from the protection seller to buyer, na?
Yes, yes, yes. From the protection seller to protection buyer. Yes. Okay. Now let's come to commodity derivatives. One of the question also we covered, I think, for a rice trader. So what is a I mean, for commodity derivatives, commodity becomes the underlying. That is very clear, right? Now all the principles of forward futures options will apply to the commodity derivatives. What essentially what is the thing that is called as commodity, which is let's say durable, first of all, which is homogeneous in nature, right?
Having market.
Having market, yes. So that means there is a good amount of price fluctuations, and its supply should be consistent. It's not that it's a one-off thing, it happened and then there is no supply later on. So supply should be consistent. Now, if I take an example, for example, there is a farmer and the farmer grows corns, and the Kellogg's company needs those corns for the cornflakes. Right now, for farmer, the risk is that tomorrow the prices of the corns goes down. Right, so accordingly the farmer will take a long position, right, so that he benefits if the prices, sorry, accordingly the farmer will take a short position so that he benefits in case the prices goes down. Similarly, the Kellogg's company will take a long position, right, in case the prices goes up, the Kellogg company's gains, right? So that will be taken for an underlying of corn, whether they want to do options or forwards, that is up to them basis their risk profile, right? Similarly, there is one more thing, which is commodity swap. For example, in commodity swap, what happens? The floating rate gets swapped to the fixed rate, right? As we know that, let's say the lot of commodities have a fluctuating prices, right? So in this swap, the fixed floating swap is the first one. So in this, the floating rate will be swapped with fixed rate, right? Similar to the interest rate swaps that we will be discussing later on in the future sessions, right? So wherein the fixed rate of interest is swapped with the floating rate of interest or vice versa. So this is very much similar.
Sir, when will your future session? Because schedule in the schedule, your session is today is the last session.
Yeah, no, no. So derivatives are going over today. For from my end, the derivatives are going in today. The interest rate futures is a separate topic that will come
Sir,
after the.
no classes for AFM now. When I checked the schedule, live class schedule, it shows nothing for AFM
Okay,
till
no. So
January.
yes, sir.
Yeah, no, there is there are classes are going on AFM. From where you got this information that there are no more AFM classes?
Sir, ICAI BOS portal, when I log in and I checked in the live schedule classes, live schedule, there are classes of other subjects, but the AFM class schedule as no class are there.
Student, we upload the schedule monthly wise.
In November, the last class showed only 14th, 13th, sorry.
For AFM,
Yes, sir.
we'll check and resolve the issue.
Okay, sir.
Okay, we will get it resolved. Don't worry, but classes are there.
Okay, sir.
Because in the next class, okay, now Devas sir, are you through with your session today or?
Sir, just last
Okay.
five,
No
7 minutes.
no problem. Please continue.
Yes.
Directly shows in January schedule and the paper 4.
Okay,
Look,
okay, beta, we will check out. Otherwise, you just send us a mail. Okay, or I will get you connected to a person. Okay, you give a call to me.
Okay.
Okay, on the online, I will get you connected. Okay, Devas sir, just continue.
Sure, sir. So there is another type of commodity swap wherein commodity rate is swapped for interest rate. Okay. For example, 8% is the interest rate. This will be swapped with the commodity fluctuated rate. Okay. So this is something on the commodity swap. So this is again part of the commodity derivative, which is something incremental, which we have not discussed till now. Now there are two more types of derivatives, which I'm just voicing it out. One is the weather derivative and second is the electricity derivative. Now, weather derivative are also gaining a lot of importance because the weather conditions, for example, in this case, the underlying becomes the humidity, the temperature, let's say the rainfall, and it is very much important. It is very much important for a lot of business activities which are dependent on weather as their seasonal part. For example, a farmer, right? In case the underlying becomes a weather and a relevant product or a relevant position is taken, the farmer can protect himself or herself from the risk of upside or downside as the case may be. Clear? But one more important point to note here is that we are not talking about the insurance companies which insures the extreme weather conditions. For example, earthquake, for example, floods. These are not part of the weather derivatives. Finally, on electricity derivatives also, the prices of the electricity is actually dependent on lot of factors. For example, availability of the fuel, right? Something related to the demand and supply. Some of you also might have heard about the power purchase agreements. In case electricity is generated by a private person, it is purchased by the government. So from both consumption and supply side, the businesses are exposed to the different fluctuations in the electricity prices. So the electricity derivatives are nothing but where the underlying is the electricity price, and any derivative running on that electricity price is called as electricity derivatives. Okay. Similarly, for example, one of the example to give is one is electricity swap, which will convert the fixed rate to the floating rate or floating rate to fixed rate, as the case may be. Yes, Pooja, you have some question. You have raised the hands.
Sir, in commodity derivative, you said that the fixed floating swap will be there. So fixed and floating swap is based on percentage you are talking, but it should be related to the price.
No. Wait. See, I talked about two things here. One is the fixed floating swap, which I said that the floating rate will be swapped with a fixed rate. For example, the corn is, let's say, 10 rupees per kg. This is the fixed price, and the floating price is whatever is going into the market. Correct? So it will be fixed for the commodity. For second part, which is commodity for interest swap, this is the second type of derivative. Here I said that the interest rate percentage will be swapped for whatever commodity rate is appearing in the market. So let's say commodity rate fluctuations denotes that there is a 10% movement basis the market, but that we will be exchanging again the 8% for interest. Clear? But the way this 10% is calculated is basis the commodity rates. Okay. Now, I think these are some of the MCQs which all of you can, attempt. You can just write the questions, write the solutions on the query handle or on the chat box. Okay. So this is a good, these are good 6 questions which will help you test your knowledge till now. Okay. So the question number 1, while calculating the theoretical minimum price of a forward, return in the form of a dividend is dash from the spot price. It's the easier one. Yes, very good. This is actually subtracted. Right? Today also we covered one question. Yes, so Nisha, Sahil. Yes, very good. Thanks for answering. You can use the query handle also. Then question number 2, dash is used to reduce any substantial gains losses suffered by, I request to use the query handle only. Don't voice over the answer, because then other students might get confused with the solution, right? So let all of you answer on the query handle chat box. Okay. Dash is used to reduce any substantial gain loss suffered by the organization by taking a position in one market against the existing position in same or other market. I am getting answers. Monica, yes. Nisha, yes. Both of you are correct. Yes, I think all of you are correct. This is called as hedging. Right. Ojani, you are also right. In third question, in which of the following cases payoff can be unlimited to the option parties? This is a tricky one. Okay, Monica and Nisha, you have answered it, but this is a bit tricky one. So if you go by the concept, right, then yes, D is the right answer, but practical limitation is there that put buyer cannot also have unlimited earnings, because the share price cannot fall below 0. In a way, call buyer is the one where the unlimited earnings will be there to the parties. So Pooja, Nisha, Monica, I think all of you attempted it right. So it will still the correct answer is A. Now question number 4. In Black-Scholes model, ND1 represents the dash of the shares and of stock to options necessary to maintain a fully hedged position. Yes, tell me A, B, C or D, whether it is a strike price, present value, interest rate or hedge ratio. Yes, I think all of you are correct. Pooja, Ojajini, Nisha, all of you are correct. Very good. This is hedge ratio. This we have covered today also, right? Then question number 5th, call deltas are dash, put deltas are dash, reflecting the fact that the put option price and the underlying stock price are inversely related. Today only we covered this concept. So call deltas are whether they are positive or negative, or put deltas are whether they are positive or negative is what we have to say. So Pooja, you are right. Nisha, you are right. Monica, right. Ojajani, you are also right. It's C is the right answer, right? Call deltas are positive and put deltas are negative. Then lastly, right to abandon a project at some future date at zero or certain prices equivalent to. Yes, very good. It is C, which is shorting the call. Okay. So with this, students, the session comes to an end. Thank you for your patient listening. Uh, I request now see Ashish sir to please help with the concluding remarks. Thank you, sir.
Thanks, Divas sir. Thanks for your session. And because in the end, you have taken some MCQs to test the basic conceptual understanding of the student, and it was well answered by and well responded by the student as well.
Yes,
So
sir.
student, now when this is of course a major part of the topic of derivative analysis and valuation has been over. Okay, there is one topic has been left, that is real valuation, real options that will be covered in the forthcoming classes. Okay, now student, when we talk about the derivative, there is another term that is called financial engineering, if you have heard of the same. Now it is something, if you see, it is just kind of a, when we were doing the derivatives, what we have analyzed that like Black-Scholes models, put option parity, binomial model, all these are something are financial products. Okay, now in today's world, the financial products have been so of wide range. And even if you see stock exchange and many options, many type of options, exotic options are available. So all these are covered in the financial engineering, because now different types of financial products are designed to meet the lender or borrower's need. So that's another field. Generally, sometimes students say, sir, what is financial engineering? So we can say from financial engineering, we can say we make a financial product. Okay, this can be interest rate swap, is also a kind of a financial engineering. So you can understand financial engineering is also a part of the derivative, is also a part of the financial engineering, from where we can make the. Now, as usual, if you have any query, you can contact us at this telephone number, and especially regarding your query regarding schedule, you just give me a call at this number. I will get you connected to the technical team. Okay, and you can have a direct talk with him, so that this matter can be resolved. Okay, or otherwise, for other students, you can send us the mail at sfm-final@ICAI.in, or you can also send your query at the BS mobile app. So with this, we come to the end of this today's session. Thank you, student, for patient listening, and thank you, Divas sir.
Thank you, sir.
And Ginny, you have thanked sir providing LVC for us, and there is very much beneficial to us, and we are also enjoying. Thank you, Ginny. This is a word of token of appreciation from your side. Encourage us to improve further. And if you have any suggestion, you are free to share with us. No problem. My email is there. I've shared with you. You are free to discuss, because only your suggestion will improve the quality of our forthcoming classes. So, okay, student, revise whatever discussed in previous classes, and see you in the next class. Thank you very much.
Thank you. Thank you. Thank you very much. Thank you, sir.
Yes, session over.
Session.